Good afternoon, everyone. I'm excited to be here with you and share the national outlook. So I'm Sarah House. I'm a senior economist with Wells Fargo in Charlotte, and I cover the national economy for our team. And when we look ahead to 2020 and the overall economic environment, the phrase "may you live in interesting times" springs to mind. So that is attributed to an old Chinese proverb, which I think is very fitting considering some of the trade dynamics we've seen and how prominently China's been featuring in both the U.S. and global outlook. But beyond just that, if you look at the labor market, as we've already discussed, it's the tightest we've seen in decades. You have equity markets near all-time highs and pretty tame inflation at the same time. And despite this great environment, you've had the Fed actually cutting rates over the past few months. So what gives? Well, of course, it does stem largely back to the slowdown we've seen in global growth generally, but some of the trade issues we've seen specifically. And all this is coming at a time when we are, by a number of measures, pretty late into this economic expansion. So I'll unpack what we're expecting for growth. You're going to see a lot of the same themes that Dr. Von Nessen talked about, so we'll go through those pretty quickly. But talk about what that means for Fed policy and interest rates going forward in the next year, but also what some of the other risks are out there beyond trade and what that might mean for the timing of the next downturn and what that next downturn also might look like in terms of its extent and duration. Now, before diving in here, so how many of you think we will get a recession next year? All right, so, okay. Not too bad. So Dr. Van Nessen did a really good job convincing you that. Well, that's great because there was a study recently that came out from Harvard, a joint study by Harvard Medical School and Boston University saying optimists live longer. So this is good news for this crowd. Okay, so we've discussed in part that we're now in the longest expansion on record. So you can see that with that left-hand slide chart there. So some people feel like we're due, not this crowd, great, which is good because if you think about where recessions come from, it's not from old age, but it comes from either some sort of imbalance in the economy. So think housing in the 2000s, so that was a major imbalance, had to be corrected, brought a recession along with it, or some sort of shock. So this could be a policy shock along the lines of monetary policy. So for example, the Fed raising rates too quickly. Well, that risk seems to have been removed with the Fed having backtracked over this past year and actually cut rates already 75 basis points, and I think firmly being in more of an easing stance. They have an easing bias right now, I would say. But of course, there are other shocks. So trade, I think, is the one that features most prominently among that. And as Dr. Von Nessen already highlighted, is that the problem is, well, it's been the longest expansion on record. It's also been the slowest. So this is in part for some long-term structural reasons, like just lower potential growth given what we're seeing in terms of labor force trends, productivity, but it does mean that there's less room for error in this case. And so we are in many ways more vulnerable, particularly given that we are seeing some signs of late cycle. Now, that said, we do think that the expansion can continue on, but it will be at a slower pace than what we've seen over the past couple years. So if you go back to 2018, we were growing almost 3%. That downshifted to, we think, when 2019 is all said and done, probably about 2.3%. But next year, we think growth is going to come in slightly under 2%, so probably somewhere around 1.75%, 1.8%. So still a pretty decent rate, but below average for this expansion. Now, part of that comes from the removal of fiscal stimulus. So we saw not only a bump in terms of to the economy in terms of the indirect effects from the Tax Cuts and Jobs Act in 2018 and 2019, but you also had the budget deal that increased direct government investment, which is what you have here on this chart. So that's that decaffeination. But then, of course, you have the trade war. Now the direct costs of the trade war are actually pretty small when you think about it in the context of the U.S. economy. So this chart looks at how the amount of goods subject to tariffs now and then applies the tariff rates. You can see that we've seen an escalation over the past almost 2 years now. And we are set to see things escalate further here in just 12 days with the December 15th tariffs. But overall, when you step back and you look at that overall direct cost, $120 billion in a $21 trillion economy is not on its own enough to derail the U.S. expansion. What about the inflation effects? Well, we have seen an uptick in goods inflation, so that's kind of this orangey line at the bottom here, where for the better part of the past 5 or 6 years, we had seen outright deflation for a lot of common goods that households buy. But at the end of the day, most household spending is on services. Think of some of your biggest expenditures. It's probably housing, healthcare, not necessarily a lot of your wallet share at the end of the day going to things like to physical goods. And that's why inflation does tend to track, overall inflation tends to track services. By our estimates, the tariffs that we've already seen go into effect have probably added about 1/10 of a percentage point to inflation. So that's practically a rounding error, not enough to derail consumer purchasing power. Now, part of the reason that inflation has been pretty tame, even with the tariffs, has been that companies have absorbed this to some extent. So we've seen pretty high profit margins, but we're seeing those come down as companies have absorbed that. So if you look at the blue line, that's after-tax profits as a share of GDP. So that's been stabilized in part from the corporate tax cuts that we got. But if you look at before-tax profits, which are kind of an underlying gauge of corporate profitability and cost pressures, you can see that that's coming down. That's something that we typically see later in the cycle. So that's been in part from tariffs, but also just from the increase in wage costs. Now, the bigger impact in terms of trade has been some of the indirect impacts, so on business uncertainty. So we've seen capital spending plans come down, but I'll highlight that we've seen a bigger pullback in terms of manufacturing capital spending, given that these companies don't know what their input costs are going to be, they don't know how competitive they might be if they're facing retaliatory tariffs. But notice the blue line there. So this is small business capital spending plans. It's downshifted a little bit, but overall has remained noticeably stronger. And this is encompassing more industries than just manufacturing. So you're still seeing businesses out there spending. And when we look at business investment for the year ahead, we're estimating that it'll grow about 2%. So we're actually still seeing some investment growth, although it's not as strong as you would typically see in a cycle. So typically you're seeing business investment run 3, almost 4 percentage points above top-line GDP. So still seeing some headwinds there in the investment environment. But it's important to remember also that the composition of our investments are shifting. So we're seeing the strongest area of growth and investment tends to be for intangibles, things like software, which is used much more by the service sector. And so that's really what's keeping this positive, is that it does have a shorter lifespan, but just also as the economy shifts more towards a service-based economy, you need more type of that investment. Companies can put on hold some of the big equipment expenditures or maybe some of the big construction projects that also feed into overall business investment. So Dr. Von Nessen already highlighted that we're seeing a slowdown in global growth. So this looks at global industrial production just as a proxy for global GDP. But when we look at global GDP, so we're looking at another year of roughly 3% growth. So that would be the same as what we think 2019 will come in. So really 2 of the weakest years for global growth since the financial crisis. And that's coming because the trade war does have knock-on effects to other countries. So even as we've seen investment pull back here in the US, well, that affects demand for capital goods in places like Germany, whose economies are much more dependent on exports. So we're seeing that spill over into slower global growth. And so that's having feedback effects in terms of even manufacturers and exporters that aren't directly impacted maybe in some of their input costs with tariffs, where just that demand backdrop has weakened. So we've already looked at the ISM manufacturing and non-manufacturing indices, so you can see that weakness has really been concentrated in the industrial sector. But the manufacturing accounts for only about 12% of the US economy. So the other 88% is still holding up pretty well. And when we look at this gap that's emerged, so that's a signal that if you can get some clarity around trade, that the final demand is still there for the manufacturing sector. And so similar to what we saw back in 2015, 2016, we think that this gap will close by manufacturing activity rebounding rather than the spillovers being so severe in terms of the manufacturing industrial pullback that you see it spill over into services. All right, so what's keeping the expansion on track? Well, we talked already a little bit about housing. So housing was really the outlier in 2018, where you actually had a pickup in consumer spending, you had a pickup in business investment, but housing began to stumble. So in part that was related to higher interest rates. You also had a lot of tax changes that weren't as advantageous to the housing sector. We talked about the higher labor costs and lumber as well, but I think a big factor was that increase in interest rates. Well, now with interest rates coming down again, that's breathed some fresh air into the housing market. And so we've seen construction rebound, particularly for single-family homes. So single-family home construction is up about 8%. And it's begun to shift in terms of more entry-level homes. So that's really where the void and the dearth of construction has been, making it hard for a lot of households to get into the market. Now, when we look ahead to the coming year, so we're only expecting about a 2% increase in residential construction. So not much of a lift in the year ahead. And that's coming in part because we're still seeing some challenges in terms of, one, affordability, but also just turnover, which is limiting the impact, and limiting growth in residential investment. So on the affordability side, so the good news is that we're finally seeing income growth outpace housing costs in the national arena. So, but that's followed about 6 years where housing prices were outstripping overall wages and salaries. And this is overall wages and salaries. So this is factoring in that more people are getting jobs. If you are already working and you're only seeing your more typical average hourly earnings growth, then house prices continue to outpace income. So there's still a big affordability challenge, particularly for younger households, which are having trouble saving up for that down payment, where a lot of these affordability indices assume you have a 20% down payment, which is pretty hard considering younger household student debt burdens. The other issue is mobility. So we've seen a long-term decline in mobility in terms of people moving, so that's limited overall housing turnover. So part of this is demographics, but even if you were to look at individual age cohorts, you would see a similar pattern where pretty much every demographic except for your 75 plus has seen a decline in moving. So this is an impact in terms of GDP because you're seeing less sales, that's less brokers' commissions, but also when people move, you tend to want to put your own spin on the house, and so you get improvement investments, so remodeling activity. Different spending where, okay, maybe that couch doesn't quite work right there, so you go out and you buy some new furniture. So there are spillovers to the fact that we're not seeing as much activity in the housing market, that it does seem to be on a lower path. So the good news is consumer spending in general, though, remains pretty strong. So we are expecting a moderation this year. So in 2019, consumer spending will grow about 2.6% in real terms. We're looking at probably 2.2% in 2020. So still a pretty good number, but a downshift. Now, why we think that consumer spending can hold up in light of some of these major trade headwinds that we're seeing and some pretty negative headlines is that overall consumer fundamentals remain in really good shape. So if you look at household balance sheets, you have net worth, which is that dark line, at all-time highs, so even if you adjust for inflation and population growth. Now, historically, when households have had their net worth climb, they feel like, okay, I've got saving elsewhere, I can go out and spend more, and you see that saving rate decline. Not this time. So you're actually seeing the saving rate increase even as wealth has increased. And so that gives households a pretty decent financial cushion. Looking specifically at the debt part of household wealth, so if you look at debt service, so what households have to actually spend out of their monthly income towards prior purchases, so that's fallen in housing to historic lows. Now that in part reflects lower interest rates as well as lower home ownership. Where you have seen more debt growth has been in categories of consumer credit. So this is things like credit cards, auto loans, student loans. But even with the growth that we've seen in consumer credit, you've seen that debt service has been pretty stable over the past couple years as income has also rebounded. And it's still, well within its historic range. It isn't at a level that's screaming that households are really stretched thin. Now, another way to check on the health of the consumer is to look at delinquencies for various types of consumer credit. So we can see that the top line there is student loans. So student loans, its own beast, very hard to discharge in bankruptcy, so you tend to see higher delinquency rates. But if you look at some of the other categories, you can see that mortgage delinquencies, home equity lines of credit delinquencies continue to trend lower. But you have seen a bit of an upturn in terms of credit cards and auto loans. So credit cards, we have seen a pickup here, but at the same time, it's still low on a historic basis. The auto delinquencies are a little bit more concerning, but if you look at the composition of who's actually borrowing, this isn't all of a sudden that prime borrowers are having trouble servicing their loans. So we've seen credit expand back more in towards subprime borrowers, and so it's a little bit of a different credit profile. So you'd expect subprime borrowers to have higher delinquencies on net. Now, why we're not terribly worried about rising delinquencies in this area is in part because we've actually seen credit tighten up and credit growth has slowed. So this is going to be another factor that leads to slightly more moderate consumer spending growth in the year ahead, is if you look at both lending standards, which are those dark lines, so if those are declining, its banks are tightening up credit. And the blue lines, if those are declining, it means that there's also less demand. You're seeing both tighter credit and lower demand. So that's a recipe for slower credit growth. But you have seen lending become a little bit more disciplined in terms of consumer lending, as well to some extent as business lending and especially commercial real estate lending. So that's in some ways putting a little bit of a tapping of the brakes in terms of overall growth. You'll notice though that housing, your GSE eligible loans, that's one area where you continue to see an increase in demand and credit, though. So that's a signal that housing is going to continue to make modest gains to the economy next year. All right, so let's talk about monetary policy and its major drivers. So another reason we think that consumer spending is going to be in pretty good shape next year, even as we see some moderation, is the wage growth that we've already discussed to some extent today. So this is just another way of looking at it. It looks at average hourly earnings growth in the highest 40% of paying industries versus the bottom 40%. And what you can see here is that really where we've seen the strongest wage growth, it has been in those lower paid occupations. So this is encouraging in terms of broadening the base of consumer spending. So these households do tend to spend more of their income, and so you're no longer relying just on your very upper income households to fuel spending and growth. So that's encouraging, and also a sign that the labor market is genuinely tight. Now, when we look at employment growth, we do expect some moderation for the year ahead. That's going to be a continuation of a trend we've already seen this year. So private sector hiring slowed from an average about 180,000 in the 6 months through April to closer to about 140,000 over the past 6 months. You'll notice, though, that most of that slowing has been in what we loosely labeled blue-collar work. So this is more of your industrial exposed industries like construction, like energy, manufacturing, and then transportation services. So where we haven't really seen a slowdown at all is in these other components, which do tend to be more tied towards your traditional services, or at least less exposed to the global slowdown. So in other words, this is a sign that we're not seeing that spillover from that global weakness or manufacturing slowdown really spill over into other sectors, and that's going to keep the broader expansion on track. Now, that said, we are expecting some moderation in the year ahead, and part of that is tied to demand. So demand for labor is by no means falling off a cliff. That's evidenced by the fact that jobless claims remain pretty steady. You can see that on that left-hand chart. But you have seen some pullback in demand for workers via the share of businesses planning to hire, or just the overall job openings in the economy. So that does suggest that you're going to see slightly slower job growth in the year ahead. But it's also a supply story. So as the expansion has continued, overall labor force participation, which is that light blue line on the left-hand side, has been fairly stable, but that's come despite the fact that, of course, we have the baby boomers hitting retirement age, and so that's putting a lot of downward pressure on participation. But if you hone in on what we call prime age workers, so 25 to 54, most likely done with their higher education, too young to be retiring, even if they've done very well for themselves, you can see that that's been increasing pretty steadily since 2015. So we are drawing workers back into the labor force, but we really need this to continue if we're going to still see 200,000 plus job numbers, which we just aren't, because as you look on that right-hand side chart, you're seeing a slowdown in terms of the overall rate of the population growth. So you don't need as many jobs year in, year out to keep a labor market tight. Now, does the fact that we're seeing stronger wage growth mean that inflation is right around the corner? No, not really. So in some ways, the historical drivers of inflation have changed to some extent. So wage pressures, I think, are putting some increase in terms of inflation. You're getting probably another 1, maybe 0.2% from the tariffs if we see those tariffs on consumer products go into effect later this month. And so that's going to be pushing up inflation after we've had kind of some choppiness due to some one-offs over earlier this year. But bottom line, inflation remains pretty tame. So yes, while you have this upward pressure from wages and tariffs, you also have better productivity growth in the economy. So it's actually easier to pay your workers a little bit more if they're producing more for you. But you also have, you've really had a rebalancing of inflation expectations. So consumers expect lower inflation, and businesses are more reluctant to pass prices on. So that's really anchoring inflation to a point where it's almost too low as far as the Fed's concerned. They would like it to be a little bit higher so they have more room to cut real interest rates should they need to. So where does this leave the Federal Reserve? So we've already seen the Fed cut 75 basis points since this summer. And this is really for risk purposes. So we've seen while the economy slowed to some extent, that's been evidence in the GDP, some of the ISMs are a good summary measure of that, things are still plodding along pretty well. So we're not, there hasn't been, big red danger signs flashing. But the Fed really took these rate cuts out as insurance. And when we look ahead, right now they've signaled that they're okay with where they are for now, but we actually think we'll probably get one more rate cut here in the first quarter. And that's coming in part from the fact that our assumption is that we don't get a phase 1 trade deal, or at least anything meaningfully completed on the trade front. So this uncertainty continues to linger, and we're probably going to see GDP growth with a 1 handle on it over the next couple quarters, and we think the Fed's going to feel like they need to do something. So probably not quite done easing yet. As when it comes to inflation, again, the Fed's not worried about that. If inflation does pop up, they know how to deal with too high inflation. It's too low inflation that they're struggling with. So Fed's going to remain easy as we look out, not just over 2020, but even over 2021. All right, well, what about the risks out there beyond trade? Well, one of the reasons that the Fed was being so proactive with cutting rates is that we did see a traditional recession indicator earlier this summer invert. So the yield curve is widely watched by financial markets. It's inverted ahead of each of the past 7 recessions. It's also inverted, though, and not been followed by recession. So you have to be careful in terms of how much weight you put on this, particularly in a world where the Fed has been actively trying to push down longer-term rates, where through quantitative easing, where you would get a yield curve inversion earlier rather than later. But even if you think that this time might be different, the fact is that financial markets do pay a lot of attention to this one particular indicator, and so the risk becomes that this could potentially become self-fulfilling, that financial markets get on edge, and so it doesn't take much to create a sell-off, and that could spread into the broader economy via confidence and asset prices. Now, as the Fed has cut, we've seen the yield curve steepen again, so no longer negative, and the length and how deeply negative this goes is important, where even though it inverted, it wasn't for nearly as long or as deeply as we've seen in prior recessions, ahead of prior recessions. But then I'd also point out, if you look at at a broader look at financial conditions, that those remain on net fairly accommodative. So this is a financial conditions index that includes not just treasury yields, but also corporate bond spreads, equity volatility, and you can see that broader financial conditions remain easy relative to pre-crisis norms. So not flashing nearly the warning signs that the yield curve was earlier this year. Now again, though, the risk becomes that does some of this nervousness become self-fulfilling? The fact that we are in the longest expansion on record, while this room feels pretty confident, a lot of people still feel that we are due for a recession. And so do we see risks via that confidence channel? And while the yield curve has steepened again, we've seen a slight tick up in CEO confidence. Consumer confidence is still kind of range bound from where it has been over the past year. So really, after we saw the stock market sell off this time last December, we haven't really seen confidence come back after a shutdown, trade volatility, more trade volatility. Now you have impeachment discussions on the table, and so even as we've seen the stock market climb back towards all-time highs, you haven't seen confidence follow it. And historically, as you've seen confidence level out, it's not even that you need a decline, it's that if you're no longer seeing improvement in confidence, that usually portends a slowdown in discretionary spending. So this is another reason why we think consumer spending is poised to moderate. But it does remain a risk that you see a broader drop in confidence could really lead to a pullback in consumer spending. What about the election? So could that be a risk in terms of the overall economic expansion? Well, the good news is that historically you don't see any statistical difference in terms of growth in an election year versus not, even as you might have added uncertainty. If anything, you actually see slightly stronger growth. So we don't think that in terms of the broader economy that the fact that next year is an election year itself is a risk to the outlook. Okay, and then real quickly, let me talk about some imbalances, since those are another area where a recession can stem from. So as mentioned, households remain in great shape. So that's this orange line here. So this is household debt relative to GDP. You can see the imbalance that built up around the 2000s and how that debt has been unwound. That's also been part of why the recovery has been so slow, is that households have been repairing their balance sheets. But if you look at business debt as a share of GDP, that's at an all-time high. And while government debt shot up in the recession, it never corrected since. So that remains high. So let's talk about those two briefly. So yes, you have yes, you have business debt at an all-time high relative to GDP, but if you look at business assets, those are also at an all-time high. Companies are holding a lot of that debt long-term, so the refinancing risk is pretty low. And so from that perspective, you could say that, oh, it doesn't matter that the debt's so high. If you look at interest coverage, so that remains in relatively good shape, but we have seen a deterioration. So businesses right now aren't having trouble servicing their debt, but it is getting a little less room for error. And if you were to see a significant hit to profits or earnings, then companies could have some trouble. Same thing if you look at net debt, which is really debt minus cash and other liquid assets relative to earnings. Now, you need some sort of catalyst, I think, for this to become a problem. And so this isn't something that we think is really going to necessarily trigger the next recession, but it could be something that makes it worse in terms of companies have more repair work to do on their balance sheet to get out of once the recession does come and they do see their earnings decline. Okay, what about federal debt? So we're at a pretty unique time in history. So historically, as you've seen an expansion continue, you see deficits narrow as revenues pick up, automatic stabilizers decline, but that is no longer the case. So we are once again set to run trillion-dollar deficits and see that deficit widen over the next year or two. Now, this isn't necessarily an immediate problem, so right now we're not having any trouble financing our debt, so especially given how low interest rates are elsewhere in the world, there's still a good amount of people who want to buy Treasury debt. But if you look at the CBO's projections, though, this is set to continue in terms of the overall amount of debt outstanding. So why is this a problem for the current cycle? Well, it does mean that you're going to have overall higher interest outlays to service that debt. And so higher interest outlays means less spending, or you're going to need higher taxes to continue spending in other categories. Well, you can see that mandatory spending is really the big driver of this growth. So that's set to continue to take share as GDP, which means you have less room for discretionary spending. So that's going to make it harder for things like infrastructure to get done, or other productivity-enhancing investments. So whether that's funding of the sciences or health research, et cetera, there's going to be less money to go around for that. The other trouble comes, again, when that next downturn strikes, there's less room for fiscal policy to step in and help stabilize the economy. So it's not to say that Congress still couldn't pass some sort of fiscal stimulus, but the likelihood of it being as large as if the debt and deficit were in a better position means they're not going to have as much fiscal space come that next downturn. And of course, this is coming at a time when monetary policy is also constrained historically, where right now we only have about 150 basis points of traditional ammunition to stimulate the economy, whereas in the last two downturns, the Fed was cutting rates by over 500 basis points. So that also portends that, okay, so maybe the next recession isn't right around the corner, and we think we can continue to grow, but when it does come, we're running out of time to get things in good shape to guard against and really rebound from that next downturn when it eventually comes. So on that very happy note, to wrap up, so we do think that the expansion can continue. We are looking at slower growth next year, probably about 1.8% on average, somewhere closer to 1.5% the next couple quarters, but things will pick up in the second half of 2020. But we are late into the cycle, and the risk of a shock is a bit greater given this lower run rate. Composition of growth, so still seeing weakness coming out of the industrial sector as trade remains a source of uncertainty, but consumers overall in good shape. Labor market remains very strong. Some signs of cooling in job growth, but we should still see wages continue to increase, so that's good for consumer spending. Inflation, not a threat. Fed overall continues its relatively easy bias, so I think they'll be ready to step in if we do see a downshift in growth or risks really pop up again where it looks like growth could soon downshift. And then in terms of risks to watch, so we are seeing signs of late cycle. That includes declining corporate profits, even the flattening of the yield curve. And while it's tough to see the imbalances that we have out there right now immediately triggering a recession, it does look like they could be factors in terms of prolonging the next downturn once it does come.